It looks like, let's see, we've got 1, 2, 3, 4. We're at about half, a little over half. Does anybody know of anybody who is not able to attend today? I haven't heard from Brad. Rich or Krista. Well, in the interest of time, let's go ahead and get started, and hopefully they can join us. The agenda for today was really to have BTC come and talk to us about recommendations and about investment policy issues that we had discussed previously. And I think they're prepared to do that, as well as go over the fourth quarter, calendar quarter reports. So with that, I will turn it over. John, I'm not sure if you're the one that's going to start or who's starting, so I'll turn it over to you first.
Yeah, I get to start. Unfortunately, Alan couldn't be here today. I spoke with him earlier this morning, and basically that's a good summation of our conversation. I spoke, he listened, because he really doesn't have a voice right now. So, and as I tell people, joining me on the call, Jeff Birdsley and Mark Manziera, whom I think you have seen before in prior meetings periodically. Jeff is the head of our fixed income team, so he is the gentleman who oversees the fixed income portion of your portfolio. Mark is the head of our equity team, so he oversees the investments that are made in your portfolio in the various equity strategies that are being utilized. And like I tell people, we have all three of us, because that's how many it takes to fill Alan's shoes when he's not here. So, but I thought we'd start by going through the recommendation that we had in regard to the portfolio and its composition. And before I jump in, one of the things I wanted to comment on, this has been a good exercise. I would like to recommend that we do this for you at least every 6 months to go through the portfolio and share any recommendations that we may have. And in addition to that, would like to formally, on an annual basis at least, review your investment policy statement with you, because I'll be referencing some of the parameters of the investment policy statement as we talk about some of the material in just a second here. So I just wanted to put that out there at the inception of the meeting. So turning to the first page at the top, it's page 2. It has a heading called recommendation. And what we're recommending.
Are you able to share your screen, John?
Ooh, I am not.
Okay. Rosie, can you pull? Oh, there you go.
There we go. So if we could go back a couple of pages to, let's see. Okay, that's a different packet than what I'm looking at. So hang on just a moment. Jeff, you're on mute.
Is it the packet you sent earlier today? That one? Yep, there you go.
There we go. So if we go to page 2, yes, now we're on the same page, literally. So just taking a look at the recommendation that we have, what you see in the table at the top of the page is where the positioning was of the portfolio as of 12/31 of 23, and then the recommendation next to that, which would incorporate some additional equity exposure into the portfolio. And directly after the names of each asset class, we do show the constraints based on your investment policy statement for each of those asset classes. So you can see where we are positioned currently as of 12/31, where we are prospectively migrating to with the addition of another equity strategy. And just to give you some historical perspective, you know, for years and years, for equity exposure, we had a core equity strategy, which incorporated elements of growth and value. But several years ago, as interest rates began to decline more and more and stay at lower and lower levels, we migrated away from that to the value-oriented strategy that we've been utilizing for some time because it had a much higher dividend yield. And that cash flow was very important in being able to achieve the return goals for the plan because we were getting less interest income from the bonds. So we wanted to get more income from the equities, and we migrated to that value strategy, which continues to have a higher dividend yield than overall equity markets and still will play a key part in here. But what we're actually recommending is to migrate a portion of the portfolio to this core strategy. The core strategy will include elements of value stocks, but also growth stocks. One of the things that we're looking forward to is having some more growth exposure in here that will not provide you as much income, but will provide you with additional appreciation potential. And just to give you an example, when interest rates hit their low, the 10-year Treasury was about 1.5% back at a couple of years ago, and now we're at about 4.3%. So that gives you some perspective in terms of what we were doing over the past several years as interest rates were so low. And now that they've come up, we feel we have a little room to maneuver within the portfolio and add some things that aren't so focused on the production of current income through dividends. And that's why the addition of the core strategy. So we're not really changing the overall equity exposure at this time. Right now, the maximum per your policy is 30%. You're seeing on the page here where we were at 25.4%. We're actually over 26% now. So we are moving up closer to that 30%. We want to make sure we always have a little room there in case the market continues to advance, because obviously if we hit over 30, then we're in violation of your policy. So that's the recommendation right now to enhance the performance by the utilization of a core equity strategy in addition to the strategies that are already represented in the portfolio. Turning to page 3, gives a little background in terms of this recommendation and how it came about, and kind of walking through utilizing some of the information that was provided by your actuary at Gallagher. And Jeff, I'm going to let you kind of walk through this page because you have much more expertise in this area than I.
So what the actuary did was they take the future cash flows associated with the benefit payments. So they make an estimate based on the future benefit payments that are going to occur. And then they discount those at using an industry standard yield curve. So essentially what they do is they come up with the present value of those future liabilities. And as part of that exercise, they also identify a hurdle rate. So that's kind of, you got to earn this if you want to make sure you're going to make all the benefit payments going into the future. This year, on the actuarial study done back in June of last year, it was 5.09%. So that is essentially what the investment hurdle rate for this plan is at this time. And as we've demonstrated, what we did is we ran some optimization testing in preparation for this proposal. We ran optimization, we looked at history, we looked at expected returns, standard deviations. We put all that together and we tested how have we done in the past, and based on the current asset allocation, how will that portfolio perform going forward with virtually no change in risk. So I'll lay that out and I'll turn it back to John because I'll let him go through the return numbers and the like.
Sure. So in the box in the middle of the page there, you can see 3 columns: return, standard deviation, and Sharpe ratio. And the 2 lines represent the current portfolio and then the portfolio with the additional equity component in terms of core equity. So you can see the anticipation is that the return will go up by 0.1%, and the standard deviation goes up just what we would call 2 basis points from 5.27 to 5.29. And then on the right, you can see the Sharpe ratio. And don't want to get too technical, but the Sharpe ratio is basically the return per unit of risk that you're taking in the portfolio. So you can see that the recommendation raises your Sharpe ratio, so you're getting more return per unit of risk. And that's because of the diversification benefits by incorporating this other strategy. So one of the other items in regard to your actuarial study that was pointed out is your funding rate right now, or your funding ratio, is right around 88%. So we want to earn more than this 5.09 to make sure that we are getting your plan into, or keeping it in good stead in terms of its funding status, in addition to keeping it well managed from a risk management perspective. And we're really doing that with this recommendation. We'll take a look on the next page and see more of the impact of the higher return. But once again, that standard deviation, which is the volatility of the portfolio, the fluctuation in the value, both to the upside and the downside in different market environments. So you can see that basically doesn't change, but your Sharpe ratio, once again, which is the unit of return per unit of risk, does tick up a little bit. So we'll move to the next page on page 4 and share some information in a little more detail in terms of what things look like between these two alternatives, the core strategy addition and then the current portfolio. And same 4 rows for each of these portfolio mixes, the best case return for
I
those
think we're
various.
off one slide.
Yeah,
If
we
you
need to
could
go
back up
back
one.
one slide.
We need to go back one, yes.
There you
Okay,
go.
there
Thank
we go.
you.
Thank you. So what you're looking at, the top set of rows is the portfolio with the addition of the core strategy, and directly below that is the current portfolio. So within each column under those periods, 1, 3, 5, 10, and 20 year, you can see the best return that's expected over that time period, the expected return, the worst case scenario, and the expected risk associated with that portfolio mix over those time periods. So if you work your way all the way out to the 20-year level, you can see the expected return is 5.31 for the portfolio with the core strategy added. The expected return for the current portfolio is 5.21, and you can see your expected risk is exactly the same at 1.18%. So you're getting more return for no more risk. And while 0.1% may not sound that exciting, we are talking about 0.1 every year for 20 years. So you are going to be able to get a compounding effect on that. And that does become something that's meaningful over that kind of time period. So with that, we'll go to the next page on page 5 and just touch on a few points in terms of the benefits of the recommendation. The overall asset allocation, which is in compliance with your investment policy, is maintained. The underlying exposure to U.S. large cap equities is enhanced such that the estimated return of the proposed portfolio exceeds the effective rate at 5.09 and also the rate that's currently being projected for the current portfolio. Overall risk posture, unchanged. So no change there. So as we say in that last bullet point, with bond returns now in a 4.5% to 5% range, the stability of that dividend income from the value equity strategy, not quite as important as it was before, as I touched on that earlier. So this allows us to introduce a lower dividend income, but higher long run appreciation strategy like the core strategy. Core strategy, predominantly large cap equities, predominantly domestic. So as you'll recall from prior meetings, we touch on the top 10 holdings of each strategy when we review the portfolio and its performance. And this is a strategy where you will recognize most of the names in terms of those underlying holdings when you see them. But yes, as I mentioned earlier, in terms of keeping that perspective in terms of where interest rates have gone, yeah, December 31st of 2021, the 10-year treasury was at 1.5% in terms of its yield. Today, it's at 4.26. So we've seen a tremendous change in that regard, which once again allows us a little more wiggle room in terms of the level of income we focus on generating from the portfolio in terms of the equities. So with that, I'll open it up to any questions that you might have in regard to this. I realize we walked through it fairly quickly, so I want to make sure everyone's comfortable with what we're presenting here.
Barb?
second. Let's see. Yep, just remind me again, what is the reason that the dividend income is not as important? Can you clarify that for me, please?
Sure, because the interest on we can obtain in the bond market is much better than it was a few years ago.
Okay.
So we've seen bond yields come up dramatically, and you know, one of the beneficiaries in your portfolio has actually been any money that you have in the money market fund, because those yields have come up dramatically as well. We now see routinely money market fund yields around 5%. So as the rates have come up, the reinvestment of your bond maturities is going to be at better rates than it was just a couple of years ago, as interest rates have come up. So the dividend income from the equities, not quite as crucial as it was as rates went so low.
So are you fairly confident that that's going to be stable?
Well, it's hard to imagine we go back down to the levels we were at the end of 2021, but you know, you're talking to some people here who I can tell you when I started my career, the prime rate was at 21%.
Yeah.
So they do change, and I think that's the key. Is another reason why we want to walk through this exercise with you every 6 months is
Okay.
to make sure that we are reflecting the best positioning we can have in your portfolio to achieve your goals. And there will be periodic tweaking.
Okay.
Right now, we're not recommending that you raise your overall equity exposure. We're keeping it at that 30% level, but we think given the projected returns, we're going to comfortably achieve a return over that required rate as determined by your actuary without taking any more risk.
So therefore, then, like every 6 months when we go through this, things can be moved around, or there's not any time commitment? Okay.
Right. Prospectively, yes. Any time we think there's a tweak or a shift or an addition or a deletion that's merited, we can do that.
And then just one more question, and I'll let somebody else talk. Just explain again the core strategy, not just generally.
Sure. Just to kind of compare and contrast, what you're primarily invested in on the equity side is, we call it our value strategy. It's
Okay.
focused on large cap equities, but more so, in addition to that, it's focused on above average dividend income. So we have two primary metrics. I should let Mark explain this because he's the lead manager, but since I've started, we basically focus on lower than benchmark valuations and higher than benchmark dividend yield. So what we're really trying to do is have a strategy that has moderate volatility and above average income. I like to refer to it as the belt and suspender strategy, to make it really simple and illustrative, because we're focusing on that valuation perspective, but also the income. So we've utilized that extensively over the last few years because of that dividend income. But we've also introduced over the last few years, as you know, and as we'll see when we review the 1231 report, we've put some small cap stocks in. We've put some foreign stocks in. We've got a dedicated real estate investment trust sleeve. And as you'll see, that real estate investment trust sleeve still yielding about 6% to 5.95, I think. So still got some of that dividend focused in there. We're just reducing that focus a little bit to bring a little more appreciation potential to the portfolio. To give you an idea of some of the names that are significant holdings in the core strategy right now, companies like Amazon, companies like NVIDIA, et cetera. So you're going to have some of that type of more higher growth exposure, but we also have some more value oriented names in the strategy, which is why it is a core strategy. It encompasses both.
All right. Thank you.
You're welcome. Okay, if there are no other questions.
Blake, no, Blake, you had your hand up earlier. You don't have any questions? Okay, I have one quick question. Just for the group, for the benefit of the group, you made the comment that you were recommending that we change this strategy, but we're not recommending to increase our equity position. Do you
Right.
want to give some rationale as to why you're not recommending to increase that equity position?
Right. I think once again, when you look at the risk return perspective, um, by incorporating more equities, you increase the volatility. And if you happen to go into a period like the great financial crisis, when we saw the S&P 500 from beginning to end of that period go down about 50%, we want to make sure we're exercising our due diligence in terms of maintaining a risk posture that we think will help keep the fund in a good position in terms of its funding status, while also generating a return necessary to, once again, keep it in good stead with that funding status. Not to say we won't recommend that at some point in the future, just not recommending it right at this moment. But once again, that's why we look forward to doing this on a regular basis.
Thank you.
If there are no other questions, we'll go ahead and migrate into reviewing the 1231 report. Take a look at that. And it's kind of timely as we've talked about the investment policy statement. So if we could just move to the next page, we'll look at what we refer to as the compliance review. And this incorporates the parameters from your investment policy statement, as well as how we were positioned relative to those parameters as of December 31st. So the positive thing is we are within all the designated ranges in terms of the asset classes, and then the other limitations down below. So you can see right now the investment grade fixed income 60%, the overall fixed income about 74%. So I should say investment grade AAA to A minus, we have very little below investment grade, as you can see, 0.1%. We have added some preferred stock in the portfolio as well over the last couple of years, once again because of the income that it generates. And then moving down to the equity portion, you can see once again within those ranges across the various segments of the equity market. And in terms of those other limitations, the one that really kind of highlights part of the recommendation and the rationale for us is this one at the bottom, non-income producing assets. You can see you have a parameter in there that can exceed 2% of the value of the portfolio. Mark and Jeff, when they were doing the various modeling scenarios for preparation of the meeting and the recommendation, looked at adding a pure growth strategy to the portfolio. But we, once again, would have been somewhat limited in how much exposure we could have added, because we would have started bumping up against that 2% ceiling or exceeding it in terms of non-income producing assets. So a little perspective in terms of, once again, how we came up with the recommendation that we did. And then you can see the other limitations. We're all in good shape there. One that we've had an issue with in the past, investment in any one corporation, we're at 1.7% below that 2% ceiling. You'll recall we had a couple of meetings where we had Walmart stock and some Walmart fixed income exposure, and combined they did get just a little over that 2% threshold, but that's no longer an issue. As you can see, it's at 1.7%. In terms of taking a look at the next page, this just gives you a more visual of the asset allocation, both numerically and then visually at the bottom, kind of see where things are. And of course, your portfolio is overwhelmingly fixed income given the design and given the goals and parameters that we operate in. So no surprises there. And then on the next page, we can get into the performance as of 12/31. And you can see for the 1 year, your performance for the portfolio was 8.3%. So a good year last year, 8.3%, a nice solid return. And as you go down that year-to-date or 1 year column, they happen to be the same since it's December 31st. You can see how the various asset classes performed. Your fixed income, about 7.6%, the tax-exempt fixed income, about 6.9%, your U.S. equities, a little over 9%, and your foreign equities, just over 21% last year. So all those rolled up combined to create that 8.28% for your calendar year. And obviously we know you're on a June fiscal year. So, but for the calendar year, you were at 8.3%. Any questions on the performance before we move into reviewing each of the various asset classes? Okay, hearing none. What I will do now is I will be quiet and I will turn the presentation over to Jeff and Mark, since they are the respective team leaders for fixed income and equities. And I'll start with Jeff and fixed income.
Right. Thank you, John. What we're showing here is this is pretty much the standard report you've seen each quarter. And right now, the yield to maturity, that's a good indication of what the bond portfolio is yielding today. If we sold it and purchased it today, that's really close to that actual rate, actually, and that's not surprising. So it's 5.06%. Compared to their benchmark 4.54. And again, the current yield 4.9%, very high credit quality, A1, and the average maturity 9.27 with duration just slightly under that of the benchmark at 5.92. So it's very close to the benchmark in what we would call the risk component. That's the duration measure there. And but producing a little bit above average yield within the portfolio, and you can see that within the performance. Relative to the benchmark, it does own more corporate bonds. That is consistent with most pension funds. That's actually what is used to discount those liabilities, is the corporate yield curve. And you can see we do own some municipal bonds in there, and those are taxable municipal bonds. If you remember, at one point, we did Build America bonds about quite a while ago, about over 10 years ago. And so that segment of the market still held within the portfolio. Those are taxable municipal bonds. They carry a very high credit quality and were purchased at very good yields. So they're still within the portfolio, still earning great yields. And then down below, you can see the investment grade, and there is one position below investment grade that is the old Federal Home Loan Bank position that's been in the portfolio, that preferred stock, which has been in the portfolio for a long time. No movement by the regulators on that preferred stock. They haven't done anything. They just keep on sitting, making no decision on what they're going to do with that. But overall, very high credit quality, A1, and a very good effective duration consistent with the risk of the overall bond market. So with that, I'll turn it over to Mark.
Thanks, Jeff, and I'll cover the equity portion. One thing I wanted to add, though, with regard to the addition of the core equity strategy, number one, its focus is primarily investing in U.S. large cap equities. So there is, besides name recognition, a high degree of liquidity. And as John alluded to, we are very cognizant of the investment policy and the impact of introducing something, looking at all the constraints within the investment policy, specifically the non-income producing assets. So that is something that, quite frankly, like John said, the core strategy allowed us to expand the diversification and participation in U.S. large cap equities, which have done very well here. As I mentioned, they are very liquid. And for a number of them in the core equity strategy, they do pay dividends. So it doesn't necessarily minimize the dividend focus per se, while it might reduce it a little bit relative to the overall large cap value strategy that we currently have on the screen here. Nonetheless, they should complement each other on a forward-going basis. So if you look at the large cap value strategy, as John mentioned, the parameters for our strategy are above market dividend yield. And so you'll see that 2.8% versus 2.5%. And then below market valuation. And we usually look at valuation in terms of like price to earnings ratio, 13.7 times versus 16.2 times. And so then when you look at this strategy overall, you'll see that we participate in the various economic sectors, communication services, all the way through utilities. So when you think about the addition of the core equity strategy, that will also lay over these economic sectors and, quite frankly, once again, enhance the overall diversification of the portfolio. On the bottom right-hand side, you'll see our top 10 holdings. Once again, very squarely in that large cap U.S. arena, JP Morgan, Gilead Sciences and healthcare, AbbVie and healthcare, BlackRock and financials, so on and so forth. So, once again, with the introduction of that core strategy, you'll see in that presentation in the future and recognize a number of those top 10 holdings. So if we could go to the next page, please. This is our small cap strategy, and once again, it looks at basically investments between 250 million in market capitalization to 10 billion in market capitalization. So you'll see that currently we have 58 holdings. We are looking for companies that basically exhibit sustainable to enhanced earnings growth and revenue growth, all once again at a lower than market valuation. So the price to earnings ratio on this, 11.8 times versus 15.5 times for the benchmark index. You'll notice dividend yield, 1.5 times equal to that of the index, and somewhat or modestly below average market capitalization. In this strategy, we've had a lot of success in. And so this is one where, in looking at it, we look to maintain the exposure to this strategy just once again because of what small caps can represent. But if you'll recall, it's not the largest component of the overall equity construct of the portfolio. Likewise, out of the 11 economic sectors, we have exposure across the board, pretty much neutral across the board when you look at it, not taking a lot of bets on overweights or underweights relative to specific sectors, but at 58 securities versus almost 1,800 securities, what we call the active share of this portfolio is very high. We're not going to own all 1,800 or 1,791 securities. We are looking for what we believe represent the best opportunity within the small cap universe, and we'll invest anywhere from 55 to 65 companies within this portfolio. Top 10 holdings on the right-hand side, you'll see that, quite frankly, they are spread amongst the various economic sectors. Financials, as represented by Bank OZK or Bank of the Ozarks, Warrior Met Coal in materials, Mueller Industries, industrials, as is H&E, and MCOR, and then Prime American Financials. But you'll see that once again, we do have exposure throughout all those economic sectors. If we can go to the next page, please. I believe this is our international strategy. When I say international stocks, we are investing in what are called American Depository Receipts. Those are securities that are listed on U.S. stock exchanges of foreign domiciled companies. They are custodied here by usually JP Morgan or Bank of New York Mellon. The market is very active, and so that's how we get the international exposure within those companies. They're all dollar denominated, by the way. So if I go out and buy Sony, it's not in Japanese yen, and I have to do the security conversion. That's already done for us with regard to the custodian and the American Depository Receipt. Once again, a strategy that's looking for basically greater than market capacity for earnings and revenue sustainability and growth, lower than benchmark valuation, 12.6 times versus 13.7. And you'll see a very attractive dividend yield, 2.9% versus 3.1%. So foreign companies, their return to shareholders is primarily in dividend payments, whereas in U.S. companies, you'll have a mix of both dividend payments, corporate buybacks, things of that nature. So as the other strategies, very neutral. representation across the economic sectors. But you'll see some of the larger names: Total in energy, AXA Financials, Sumitomo Financials, Roche Healthcare, Rio Tinto in materials. And you'll also notice something that Total, France, Sumitomo, Japan, Roche, Switzerland. So we are cognizant not only of the economic sector diversification, but also diversification amongst economic regions like the Eurozone, like Japan, which is the largest region within the benchmark index. So, and then lastly, if I may, the REIT index. This was introduced to the portfolio about 3-4 years ago. As John alluded to, yields were low, and REITs primarily are known for paying a very attractive dividend rate. So you'll see that we have effectively 19 companies. The price to earnings ratio, once again, is lower than that of market. We don't want to overpay for a company. And then if you look at the dividend yield, as John mentioned, right under 6% versus 3.7%. The thing that I would suggest is, unfortunately, the sector allocation table doesn't break out the industries or sub-industry groups that comprise that real estate sector. So if you look at Iron Mountain, all of us know about shredding and what have you. Digital Realty, a server farm, for lack of better terms. So we can go down effectively those company names and see that they are broadly diversified. They're not focused in any one aspect like retail or industrial properties, but rather they are diversified amongst various type of industry groups. Crown Castle puts up effectively phone towers. Alexandria, multifamily homes. Global Net Lease is effectively leasehold and triple net lease properties throughout the U.S., both retail and effectively industrial storage. So that's an overview of the equity strategies that we currently use. In the future, you will see one for the core equity strategy. And once again, it's looked to be a diversifier to complement what we've already constructed on the equity side for the portfolio. So I'd be happy to entertain any questions. Well, thank you.
Okay, any questions overall in regard to the recommendation or the performance information that we just shared?
I don't have any questions. I don't see any. I just want to make sure that this presentation covered all the outstanding questions that people had. Anybody have anything outstanding that wasn't covered?
Nope, not here.
Okay, hearing none, thank you, gentlemen, for your presentation, and we will let you go ahead and enjoy the rest of your evening, and we will continue our meeting for a short period.
Okay, thank you. And
Thank you.
We look forward to getting to work adding the new strategy and having this conversation on a regular basis.
Okay, thanks.
Thank you.
Thank you.
Great, thanks, everybody. I did see, Jessica, I did see your question. I'm not sure on procedurally if we need to vote. We're not, it's nothing outside of the investment strategy. I guess I just don't know procedurally. We could put a vote on the record, so we have it on the record that we've all been apprised of this change in strategy, and we are all voting in reference to it. I don't think it'd be a bad idea.
Kathy, do you know, would the recommendation be going to the school board or not? Because I don't see why it would, because it's within the existing framework. So no objection to us voting on it, but I don't believe it's necessary.
Yeah, I don't believe it's necessary either because it's all within the framework. I just didn't know if you guys wanted something on record here that I guess we've all been present in this meeting, and if somebody wants to come back and listen to this meeting, they can see that we were all present and no one had objections to it. So I don't think it's maybe necessary to have a formal vote.
Yeah, that's what I
Before
was
we-
going to just suggest, as if anyone wanted to object, that they would do it now.
Okay.
Kathy,
Before we
could we
get
get
into
that sent out?
discussion,
Could we
I
get
think
those
Rosie
report?
posted it
Okay,
in
great.
this, before we get going on discussion regarding this report, I did notice that Matt is on the call. And so Matt, just in recognition of your time, I wanted to know, was there anything specific that you wanted to address this group on regarding the retirement incentive and talks regarding that?
Yeah, nothing specific other than the talks do continue. I think we've got something scheduled here on the books. I don't, Blake, remind me when that is scheduled.
Next week.
There it is. Next week.
Yeah, I knew there's
22nd.
something coming up,
Got it.
but I didn't know if there was anything else, and just for the benefit of the rest of the group.
Yeah, no, I appreciate that. I'm here to answer any questions that I can, but we've got that conversation will continue.
Okay, thank you. Any comments on today's report from BTC? Blake?
So I guess I want to make maybe a couple of statements that will maybe lead to where my thoughts are. That I appreciate the thoroughness of the BTC team and the fact that they are looking, within the mixtures and pieces that we have. My struggle is that at a time where we've actually seen, I think, honestly, remarkable. 2 years ago, I don't think any of us would have predicted that we would have seen the bond market create a recovery and, in a sense, almost 1.5% to 2% of growth, even within the parameters of where we were. I'm struggling with the fact that we aren't targeting a 6% rate of return as a doable, achievable, reasonable expectation. It looked to me throughout these reports as we were maybe raising the needle a quarter of a point in our expectation. And I'm struggling with that when our bond return rate is over 1%. And my comment is this, is I looked back long and hard at when this plan was in a 90-10% position. And I think about how far behind we would be in terms of our financial rates of return. I think we would be struggling to achieve that 5.0-ish% rate that was our hurdle rate. And then I think about moving to 80-20 and how we moved the needle. This is my word, so by no means am I an accountant, but it doesn't seem as if that increased exposure created a risk element to the plan that made us have conversations over the last few years of, oh my gosh, the sky is falling. Oh my gosh, we're putting the plan in jeopardy. We then in turn moved to 70-30%. And I would argue that the same thing occurred, that we moved that financial needle forward and again have not seen this increase to the risk that sometimes we default and go back to. And I'm wondering where this group stands in terms of, again, and this is a long-term, setting the stage for the BTC team to be able to look at a 60%, 40% mixture. And given that, even within the framework now, they can find some of those changes that fine tune us. But I'm struggling with why sort of a 6% rate of return is not our immediate 1-year goal. This is a big ship and we can't move it in that shape. But I wonder where people's minds and thoughts are about a possibility of moving our investment mixture strategy to a 60-40, which only empowers and allows BTC to look at that and to explore it and to come back to us with, hey, what if we even change the framework a little bit more? How much more creative can they get? How much more might they be able to look at from a return rate? Where would they come back with at the risk elements in a 60-40 mixture, knowing that we just saw a 70-30 mixture, which allowed a tiny bit of growth, no real change. There was a slight short-term risk, but no long-term change in risk. And so I feel like moving the needle seems to me, as I've sat through, I think 5 years of the reports, and I went back through about 20 different quarterly reports, I'm feeling like we've made very smart, strategic, slow steps to be methodical, smart, and we've moved the needle. And I feel like there's another step still there of growth. And I don't sense or I don't see in any of the reports where the risk makes me go, oh my gosh, we're jeopardizing the plan. So I guess I'm sort of looking for thoughts and comments about that, knowing that that's kind of a big picture over the next 6 months or year to consider to allow BTC to potentially do even more and to explore even more.
I think it would be interesting to have them further a report on that, and look at what that they perceive the risk to be if we would change to a 60-40, or what about an intermediate step? Because 60-40 to some people seems really scary, with given the number of retirees that we're supporting under the plan. If we were a plan with a lot of new people coming in, 60-40 doesn't scare me at all. But like, what if we looked at a 65-35 as an interim? You know, be from 7, you know, what if we, you know, just do a small interim change? The other question that I thought of when we were looking at it is, when you're looking at our current investment strategy and we're 70-30 and we're sitting at about 25%, are we truly 70-30? And I know that they have to leave a little bit of leeway for fluctuations, but is 5% too much leeway? That kind of came to my thoughts. So if you went like a 65-35, would we really be actually achieving our original 70-30? Because they're leaving that gap.
Yeah, and I think that's why I land on the 60-40, because in all of my 5 years, they've not been within, I think, 3% of actually achieving. Even when we were 80-20, we were like 83-17. And I appreciate that. Like, I totally understand what they're doing. They're basically creating a dynamic where if the bottom completely falls out, that they're still within their frame. That for me is why I actually, Kathy, view a 60-40 as actually a 65-35 in terms of what they would actually do. And again, knowing that we're empowering them to go there if the guidance, the direction makes sense to them, and we're paying them. They are our experts, and they report to us so frequently that I feel like it allows us to put the brakes on something if we see. And to my knowledge, we haven't put the brakes on anything for 5 years because they've done such a good job of being slow, methodical, very direct to us about what they're doing. And so would have no objection, Kathy, if the thought was to step to a 65-35 kind of a structure, but I think a 60-40 does it because of what we just talked about.
I would just like to know, I mean, they just stated that at some point they may recommend the 60-40, and they aren't saying that now. I think their concern has always been making sure there's enough. I mean, you know, the paying out the retirees is, and keeping that balance. But I think that's a good question to ask them. Why not the 60-40 now, and when would they? And I'm much more comfortable with 65-35, just the taking a baby step.
And
Yeah, and
I think I specifically tried to ask, sorry, Blake, in that their reason for not increasing the equity position. I wanted that to be stated in this meeting so we could all understand why they're taking that position.
And I think that, and I don't know this would be in my opinion, I actually would not find it to be appropriate for them to be making that recommendation to us unless if we gave them a specific goal, like saying our goal is 6% rate of return. They're going to come back then and make a recommendation to change the investment because they know that they're falling short. I actually feel like this is our responsibility to identify what are our goals and objectives. Are those being met? And go back to them and say, these are our goals and objectives. These are our priorities. Does the current mixture achieve that? Are we short? Are we high? And so I think this is what's hard for us, is that we're not necessarily those financial people. But if I'm on that side of the equation, I'm I'm going to have a hard time making the recommendation to that group to make that shift where we know that there's going to be a little bit more risk. Because if it blows up, which the chance of that is very, 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 very small, but that's not a place. I think our goals need to drive the decision and then ask them based on our goals what we want.
That makes sense. I mean, what they're saying is what they have in place exceeds the hurdle rate. And that's really what they're targeting. And if we aren't comfortable with that as a strategy, then we need to articulate what our strategy is as a group.
Yeah, and I can fairly say on behalf of all of the actives that the hurdle rate is great, and we understand that, but that hurdle rate is not moving the needle in the long term for that particular group. And I would say on the retired side, it's not going to do a whole lot for excess earnings. It does provide if we want to view it, the protection. We know we're covering our expenses, but I do think it's fair for us to expect some growth and that we're trying to push that again, especially when we see that our bond rate of return has made a significant bounce in the last 18 months. And again, because we've got 8 and 9 year commitments down that road, I just felt like the growth rate did not match what the bond rate has actually improved by over the last 18 months.
Hey, this is Lucy. I was just thinking a little bit about kind of what you're talking about, and maybe one item you could suggest or ask them to look into, just doing some modeling about if we were really focused on trying to increase the return to 6%, let's say, what items could you adjust in the portfolio to help us get that? Whether it's relaxing like some of our quality constraints or moving our equity position, but just having them do some modeling and tell us the upside and the downside with maybe some of those different decisions. Because I think, like you said, Blake, if we give them and more permission to like explore, even if we're not saying make a change yet, then they might get more creative perhaps than just doing kind of what we've been doing always in the past.
And I can certainly reach out to them after this call and ask them to model. I might say a 6%, a 6.2%. I mean, I just want to look at some different things and what they would recommend then our changes in our investment mix might look like to achieve that. Because if they come in at, a 6% is, and I'm just throwing this out there, making up things, guys. 6%, could be achieved by the 65-35, but we could get 6.3 by going 60-40. Then we have to decide, are we willing to take on that additional risk for that additional 0.3%? So I think if we could get them to model maybe a couple different things, and I don't know if they want to do it is, our target 6%, what do we have to do to get there? Or give us, if we went 60-40, 65-35 and some other variables, what our target rate would be. I don't know how they want to come about it, but I'll give them both scenarios and they can.
And we do have some of those models already, because that's what they presented to us kind of at that last meeting, was that where those come out. I think where I appreciate Lucy's question was, how about within the existing frame, what can be shifted? And again, how much are we moving that risk needle and that potential growth needle? Because I think that it's clear to me that the goal that they're seeing and perceiving is, let's just get over that hurdle rate and let's keep this plan as protected as possible. And again, we all agree with that, but I also think there has to be the expectation of excess earnings for retired members and getting to rates of return that actually seem to make a little bit more sense as the bond market is recovering. And we should still see another pretty decent return as things eventually are going to start to calm back down. That's where we're actually going to see some of that growth on the back end of that curve. And so I just look at the next kind of 36 months in a way to say, how can we reset ourselves in a way so this plan pushes everybody in a positive direction without really going crazy on the risk.
So am I hearing you want me to communicate back to BTC and ask them those questions of how can we achieve 6%? What can you do within our current structure? And then what could you do if we changed our investment policy into different ratios? How could we achieve those goals? And what's our risk tolerance under our risk exposure under each one?
Yeah, and I
Am
think also
accurately
helping
stating
us
that?
to yeah, and I think Kathy, it's also to help us to understand what that means when we say risk, because I think we throw that word out there and then all of us, myself included, we panic. Like, what exactly does that mean when we are looking at those risk numbers? Even on the chart today, I was a little bit like, okay, I see that the risk tolerance is a 5.29% for this year, and it goes to 1.88 over a 20-year run. I kind of in my mind know what that means, but I'm not sure that I'm clear in terms of really explaining to a member how much risk and what we're actually putting in both the short term, but also the long term effect.
Okay. So I think the last time we met, we agreed that we were going to move to quarterly meetings.
Yep.
But keep me honest, you guys, I cannot remember when we decided, like what months we decided we were going to meet them. So we met, were we going to meet January, April, and that is quarters, and but go like the third week, or because we needed them to have time to prepare, or were we going to do like February as the first month so they could, I don't remember. I didn't write it down and I don't remember. Does anybody remember?
I don't remember that we defined other than
No.
we were going to try to always be right after they would have their quarterly report
Yeah.
done and ready to present to us. Although I would suggest that maybe an April meeting for this discussion, because we're still kind of in the middle of it and we don't necessarily need a quarterly report from them, that would give them 2 months. But that's just my opinion. Instead of waiting until May, June, where things get a little springtime busy.
I'm just trying to look. I was trying to look to see if Rosie, if we had you schedule something out quarterly, or if we stuck on monthly on our schedules, because I'm thinking on the schedule right now, it shows still monthly, the second
I think it still
Wednesday
shows
of the
monthly.
month. And I don't know if by the second Wednesday of the month following quarter end, they would have reports ready. So like the second Wednesday in January, they're not going to have year-end numbers for us yet.
Right.
So I kind of feel like we should start with
February.
February and then meet quarterly from there. Does that?
Yep. Yep.
But we could add an extra one for April if you wanted to.
Well,
To
are you
discuss
thinking
this-
like May 1st or May 8th? That would be the next
Yeah.
quarter.
Yeah.
I don't feel like May 8th or 1st is that far off of April.
No. I don't
Okay.
either.
So let's go February, May, and use that, go on that cycle for quarters. Rosie, can you adjust the schedule so it's the second Wednesday of each of those months?
So
Okay.
May 8th is the next meeting.
Yep. So we would meet. Does that work well, you guys? Let me just, so we would meet February, May, August, and November. Is August bad?
August 14th probably won't be real ideal.
Yeah,
In
I'm
terms
thinking
of-
August is probably not great.
Do we move it to the end of August to do like August 28th, which would then also allow us a little bit of time to think about the elections and annual meeting and just starting to get the pieces in motion?
I'm fine with that. I just am cognizant that people are, you guys are probably trying to get your last summer fun in before, and this is not what you want to be doing. So,
I would
March-
recommend August 28th.
okay, so May 8th, August 28th, and let's look at November. Might as well just get them all on the schedule now, you guys, so we can. It'd be November 13th. Does that work? Okay.
Okay.
All right, and then just cancel the other ones that are out there, Rosie, so we'd have that. Lola, you have a question?
Oh, you finish your thought. I was just,
Nope, I'm good.
okay. So meantime, they're going, in place now is the core equity strategy. At least that's in place, correct?
Correct.
Okay. Well, that's an improvement, I think. A move in the right direction.
I agree.
Yeah, and I'm thankful. This may have been an assumption on my part, but I thought in preparation of these reports quarterly that they were kind of reviewing that already, our investment strategy. But it didn't
Didn't sound
appear that
like it.
that's, yeah. And so when they said we'd like to be doing this every 6 months, I guess I thought they were.
Yeah, I
As part
wondered.
of, as part of
why-
that review, I thought that was
Yeah.
part of their investment advisor duties.
I wondered, why haven't you been doing this if that's in the best interest?
Yeah, and
But
that
Yeah.
could be, you know, on us as well, or just miscommunication. I mean, I think we've asked questions all along, so it's not like they haven't been looking at it. I just think that they're going to take a more systematic approach to it going forward, and I like that. I think that
And I
benefits
think
all of
on
us.
our part, it's about identifying what are our goals that we want to ask them. Again, whether it's to actually make the decision or just say, hey, this is what we're thinking. I think that's what we need to do, is a lot more asking of our priorities, and then they can tell us what they can and can't do, and we can decide good idea, bad idea.
Yeah. Yep. Okay. Well, I think that's everything. I will let everybody go for the evening and enjoy your Valentine's Day, whatever you are choosing to do. So,
Thanks, everyone.
thank you.